thinking when you were talking about the nowcasting and some of the things that you're working on, they're obviously very data intensive. They probably have like a machine learning angle to them. Does that mean that the proverbial three men in a Bloomberg just can't make money anymore? Is it now at a point where you need to have this industrial scale tech machinery behind you?
I think you need the tech. There was a period there where the PC on your desk was really pretty good, actually. And there definitely was a period where you could build a macro model of quite a big economy like the US on your desk relatively easily. I think the data intensity of it has gone up now, so it's harder to do that. And my econometricians think that a weapon in their favor is the IT department that enables them to estimate things more quickly. Because, believe it or not, it can take a day or two to estimate the results of some of these models. Well, you can't tell the market to freeze while you're deciding whether the non-farm payroll was good or bad, right? Mm-hmm. The market is not going to listen if you say, please stop while my model chunters in the background. So they do think that it's important, and it's becoming more important. And I certainly think for systematic methods of managing money, the IT backing and the computer backing you've got and the ability to work in the cloud has become a lot more significant. So it is tending, I think, to favor bigger entities that can afford that degree of technology, actually. But in terms of human beings, I'm not sure I've never thought you need a massive team of human beings in macro style investing. I think anything more than, I'm going to say 1 to 2 dozen people actually doing it can be very confusing, and you can start arguing with each other instead of arguing with the market, which is what you should be doing.
Do you think there needs to be a human element, or
yes,
you think there needs to be a human element, not purely systematic?
Yes, I do. So this is the fashion on this changes all the time, right? I mean, go back to the 90s, it was nearly all, not quite, discretionary human. Then models were built that seemed to be doing well, systematic models, momentum-based, a lot of them. CTA models were doing well. And there was a new fashion, which was, I want the model and I don't want human judgment on top of it, because the human will panic at exactly the wrong moment.
It's like the joke about the portfolio manager, the dog, and the computer. Have you heard that one?
No. Go on.
So you need the computer to run the portfolio manager to feed the dog, and the dog to bite the portfolio manager if he tries to touch the computer.
There you go. So that was believed very widely, I think. I think now, so here's my view at the moment. I think that the dichotomy between systematic and human discretion is less than it was, actually. I think many, and we certainly are trying to really diminish that gap. So we're trying to have models that inform human decisions and have humans that can see things that models are not necessarily seeing, and can judge when the model just hasn't been able in its past life to see stuff. So one example of that, actually, at the moment, we're trying to build systems that enable us to hedge inflation risk. And the team has come back to us and said, one of the problems here is that there hasn't really been a period in the last 30 years where the markets have had to react to a serious risk of inflation. So we don't have the same data sets that we normally would have. Now, they've still built the models, but when we use those models, we are aware that they're not necessarily as reliable and may need more human judgment than some of the other stuff we do where there is 30 years of daily data. So we're trying our best to make our systems, not our systems, our process, an amalgamation of the best of both of these things. Now, we've said that before, it's hard to do, but I think we're making some progress actually on this.
That's interesting to hear your perspective of the importance of the two. And in your answer, I couldn't help but notice you describing CTAs. And a lot of investors think of CTAs in some ways as a close cousin of global macro.
Yeah.
How would you describe the similarities and the differences between the two strategies?
Well, we've run CTA type strategies, and we've run discretionary macro type strategies. So there are some similarities, Daniel, and I would say that one is that they trade the same instruments. I mean, basically, the CTA and the discretionary macro person, they're trading about 200 kind of instruments, futures and cash instruments, and those are the instruments, and commodities and currencies, and those are the instruments the CTAs trade as well. But another similarity is that most discretionary macro traders, whether they will admit it or not, do have some element of momentum built into their process, right? And the reason is that's worked over a long period of time. So, and that is exactly what the CTAs do, for a living themselves. But those are the two similarities. The big difference is that the CTAs don't try to have any kind of fundamental view of what's happening in the world or the markets or the economies. They are solely, in general, this is price-driven, right? So they don't know that the Fed is meeting next week, and they don't know that there have been tariffs imposed on US-China trade. They don't know any of that. They say, who cares? I get all my information from the price. And that is really, really different from discretionary macro. It is almost completely the polar opposite. So yes, there are some similarities, but I think it's completely wrong actually to see them as alternatives, where you have to have one or the other, because they're going to give you a very different return stream and risk stream, I believe, from each other.
Okay, thank you for bringing out that nuance, because I've seen a lot of investors in terms of how they think of a multi-asset portfolio allocation. They'll create an alternatives part of their portfolio, and they'll often think of having, one or the other within that alternatives, because they see them sort of as both diversifiers against equity risk, which is the main risk in their portfolio.
That's not a bad idea, right? So I do think they can both diversify from equity risk, but they're also I honestly look at their track record. They're also different from each other too, or certainly can be at key times. So they can give you the they can both give you the advantage of diversifying your main risk in the portfolio, your equity risk. But they won't do it at the same moment by the same amount. So they're not doing it exactly the same way by any means.
Sure. Global macro strategies had this fantastic tailwind several decades ago of higher interest rates, because your default, your do-nothing position gave you a decent return. And that has obviously eroded over the time to a point where you earn next to nothing on your risk-free investments. How has that impacted global macro? And if rates rise in the future, what might that mean for the performance of global macro strategies?
Well, so I agree with you. I think high rates in the past did favor global macro strategies. And by the way, a lot of other hedge fund strategies. If we're talking about global macro here as a hedge fund strategy,
yes,
which I would say is only part of, and not a big part actually, it's a relatively small part of global macro. But if we're talking about the hedge funds, then I think you're definitely right there, Daniel, that it did help. But it helped especially and in particular because rates were trending downwards. And many macro traders were always long the front end. So whenever the front end forward rate spiked upwards, the global macro guy would say, well, look, the long-term trend here is downwards. So I'm going to bet that the trend will reassert itself and rates will fall. So I think all of that came together to give the global macro trader a good period, for sure. What would happen if rates rose? I suppose, if they rise more than to the equilibrium rate, so they're now above what we call our star, the same process may restart. What happens between now and then depends on whether you judge the rise in rates correctly, right? Because the dangerous period is between the current and the higher rate equilibrium we might move to. That's a difficult period for all markets, not just for global macro. But you're definitely right that now global macro has to work harder to earn alpha, that is, market returns in excess of what the market gives you from the asset classes, than it probably did when interest rates were higher. So I agree with that.
Okay. Another question that people often ask of global macro strategies is that back in the history, you had some fairly, maybe this is a poor choice of words, but you had some fairly large, obvious trades. For example, the convergence trade for European currencies. And these trades were big. They were in liquid markets. Every macro manager could sort of get on these trades and ride it all the way up to what was a fairly certain outcome. And the question that people have now is these sorts of big, obvious trades, they don't seem to be around as much now, and they're wondering, I guess, whether that impacts the performance of global macro. Is that a fair question? Or?
Well, we certainly did benefit from some of those trades, that is for sure. But one of my little rules in markets is things are a heck of a lot more obvious ex post than they are ex ante, right?
Yes.
So all of the obvious things that didn't happen, we've forgotten all about because,
of course,
we don't want to think about those. And the things that did happen, we think are obvious.
Yes.
Right? So there's this massive hindsight bias in determining what's obvious or not. I really do believe that. Those trades, having lived through those trades, had many periods of going in the wrong direction and people not believing them, people hedging against the tail risk that the politicians would change their minds and that eating up a lot of the returns. So they were easier in retrospect than they are than they were actually when you were living through them. So yes, in part, I would say to that one. Now, whether or not such things will reassert themselves, I mean, who knows? But I would expect they will. The pandemic was one of them, actually. And a lot of global macro players had a terrific time during the initial period of recovery from the pandemic because they read two things correctly. One, the pandemic drove everything and policy responses to it. A true macro event where one thing drove everything, right? And secondly, that the output losses would not be sustained. And thirdly, actually, that the change in the Fed at the end of March last year was so profound that it would rescue the system. Now, those were three good perceptions more by macro people than others, I would argue. And a lot of money was made by a lot of people in picking those up. So yes, some of those old trades look more obvious now than they did at the time, but we can have huge macro dislocations, in the future as well, and I'm absolutely sure we will. And with the global economy still globalizing, really, I mean, okay, there's been a problem with global supply chains, but we're still really globalizing. You would think a lot more of the shocks are actually going to impact all markets and therefore be more suited for macro thinking than for other types of investment management.
Mm-hmm. On this topic of macro thinking, would you describe that as, or how would you describe it? How would you explain what macro thinking really is for you?
Okay, so I don't think it has to be economic thinking, right? I think macro means that one or a few major forces are moving a lot of things in the financial markets. That's what I count as macro. Usually that's economics, because usually, the big economic things like the Fed changing policy or the pandemic or Trump's tariffs or a big fiscal change by Biden, those things are the things that are big enough, right, to change markets. But so is war, a conflict, politics. They can all change markets as well. It's just that I happen to know more about the economic ones, and therefore I tend to think that it's the economic ones that are the most important. But I think to be macro, they have to affect a lot of different markets through one thing that you seek to understand. And in the old days, we used to think global macro is more about interest rates and currencies, really. That's what it's about. The last decade, it's also become about equities. Now, the great Stan Druckenmiller said the other day, that's a shame, because as a expert as a trader in currencies and bonds, he's AAA. And as a trader in equities, he's only B-. I think he's a bit better than B-.
I think he's being modest.
Yeah. I think unusually modest for Stan. But no, he's AAA and everything. But you can see what he means, though, can't you? That it's taken us into fields that are not as familiar, actually. And there's more complication because there's more component parts. There's more companies with specific company stories that can sort of make the macro signal more confused. But I do think the last decade has been, to a large extent, about central bank reducing rates, quantitative easing, boosting equities, right? And if you were going to ignore that, you weren't picking up that big macro trend. And that I do count as macro. So it can be in equities, but usually in the past it's been more in currencies and bonds.
Do you think that presents a challenge in terms of how your clients might use you in their portfolio? And by that, what I mean is if they're looking for global macro to diversify their equity risk, which most multi-asset portfolios, they've got probably 60 to 70% allocated to equities, but their risk allocation is probably 90, 95%.
Yeah.
So if they're looking for you to give them something away from that, but then you're kind of having to deal with that because that's where the central bank is effectively it's the central bank's turning that into the only game in town through their policy in some ways.
Yeah.
Does that then make it hard for your clients to, how do they put you in your portfolio? How do they deal with those sorts of issues?
Well, I think definitely, yes, Daniel, if you lose as much money as equities when they go down. I mean, that, that is absolutely for sure. So I think that when clients look at diversifying out of equities into any form of macro activity, they don't want you to be fully exposed to equities and that's it, because they can get that, usually cheaper in other places, and they can get, in their minds, perhaps better stock selection as well, perhaps. So they don't really want you to do that. They would like you to not participate in very big drawdowns for equities. And they would like you to participate to some extent in bull markets. And then how well you do both is how they judge you. But they're willing to allow you to have some equity risk, like I'd say 20 or 30% of equity risk in your total risk, as long as you don't fall as much as the equity market in a bad environment. So in April last year, and then, whenever it was, September 2008, they didn't want you to add to the pain that they were getting from their equity portfolios. And luckily, I would say, well, I hope not luckily, we didn't add to their pain, and most macro people did reasonably well in those environments. So they're willing to forgive you for not matching equity gains in the rampant bull market, as long as you don't match the losses in the bear market and net reduce their volatility.
Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.